following is a CryptoCurrencyWire audio production. CryptoCurrencyWire is one of 50-plus trusted brands from the Investor Brand Network, IBN. As a multifaceted financial news and publishing company, Investor Brand Network uses its network of more than 5,000 key distribution outlets, as well as other corporate communication tools, to introduce public and private companies to a wide audience of investors, consumers, journalists, and the general public. Our reputation for highly efficient communication strategies is based on the experience and relationships our team has in the space. It is Investor Brand Network's unwavering commitment to connect the investment community with companies that have great potential and a strong dedication to building shareholder value. The following interview may feature a client partner of Investor Brand Network. Investor Brand Network may have been compensated for the production of this interview. Please be sure to read our entire disclaimer for full disclosure.
Thank you all for joining us for our latest podcast episode with Coinbase Institutional's Head of Strategy. As everyone knows, Coinbase has established itself as a top leader in bridging traditional finance and the crypto ecosystem. John, it's so great to have you on the show.
Jonathan, thank you for having me. It's a real pleasure. I'm a big fan of what you do, and I want to say I appreciate your thoughtful approach towards these topics.
Well, thanks. Yeah, well, I definitely want to give you the platform to just tell people exactly, what it's like being there on the inside of Coinbase, seeing so much happen, especially with institutional adoption. So I'll definitely get out of the way and just ask a couple questions to dive into your insights. And before we get into the debanking of crypto funds, can you share just a little bit about your professional journey and role at Coinbase?
Sure. So I spent the majority of my career in traditional assets, but always sort of the idiosyncratic edge assets. I was always sort of interested in the wonky stuff. So I guess the most important part of my career, the salient part of my career that led to this is at a fairly young age, I became head of strategy for the New York Mercantile Exchange, which at the time was the largest commodity derivatives exchange in the world. And commodity derivatives, even if you don't believe Bitcoin is a commodity or most crypto is a commodity, I happen to believe that, but even if you don't, they trade very similar to the way commodity derivatives traded for many, many years. Specifically, you have this sort of relationship between the wild west of the OTC or the DEX market tied to the centralized exchange physical spot market. You've got a lot of kind of players and characters. You have periods of opaque price discovery punctuated by rapid price discovery. You've got scandals. So it was very familiar to me. I got interested in crypto because I was an advisor to actually the originator, Barry Silbert's first company, Second Market. And I was advising them for their traditional secondary trading desks. And they had they had a Bitcoin trading desk, a secondary trading desk. This is long, long time ago. And they were super smart guys, and I just became interested. And I happen to be very lucky. I have an adjunct. I occasionally am an adjunct at MIT. And I started getting some of the really way smarter folks than me at MIT into helping me, coaching me through the technology, because some of that was built or at least studied very early at MIT. And that led to me doing a very simple white paper on the DAO hack, the infamous birth of Ethereum 2.0. And I wrote a white paper on it with a professor at MIT. That white paper got some traction, and that led to me taking a board position at Polychain, which was one of the kind of original OG, super successful crypto private VC and hedge funds. And what a wonderful place to learn about digital assets with wonderful people like Olaf and the Polychain folks. And then, as you know, it's a bit of a tight-knit community. And so you get to meet people and word kind of spreads. And then I got the call from Coinbase a couple of years ago, and I'm thrilled to be working with a great institution like Coinbase. As head of strategy for institutional, I do a lot of the same stuff I did for the NYMEX way back in the day. I think about a new product formation. I think about how to better serve our institutional clients, get those clients who are thinking about onboarding into crypto, getting them over the hump to become their first, buy their first token. And then also help a little bit on the regulatory side and a little bit in thinking about kind of where we should be internationally.
Wow. Well, let's go ahead and just talk about the problem of traditional banks closing accounts or refusing to open accounts for individuals and companies involved in crypto. Just how prevalent is this issue?
So, if you're in the world, if meaning not just being in crypto, but if you're dealing with sort of working with lots of different people and companies within crypto, if you have one of those positions where either you're a vendor or you're like a Coinbase, and also I'm on the board of directors of a group called AIMA, the Alternative Investment Management Association, which is a very, very large working group and lobbying group for hedge, private equity, and venture capital funds, thousands of them. And so from these vantage points, I was very fortunate to be able to see this, what not sort of anecdotal evidence of, hey, it's kind of weird. I'm having trouble getting, I don't want to emphasize very basic banking services, not anything that requires the bank to take exposure to things that they're uncomfortable with, that are new or risky, but just checking accounts. If you're lucky enough to have the vantage point of lots of data, then it was really obvious, painfully obvious for years that something was off. That it wasn't just sort of like really kind of out there, immature companies. Because let's face it, let's be honest, not every firm, not every person is bankable. We do have a concept of unbanked and underbanked, and that doesn't just exist for crypto. And I think it's important to be sort of to have self-knowledge, self-realization. A lot of folks in crypto, they didn't present themselves in a particularly bankable way. A lot of folks in crypto are, they'll proudly admit they're trying to upend the traditional banking system. Expect that assets like crypto, assets like commodity options, they are tougher to bank. So even with that discount, it was painfully obvious that something was really, really off. And nobody really outside of crypto believed or even cared, to be perfectly honest, about our problems. And then Mark Andreessen went on Joe Rogan, and then the election happened. And suddenly it went from everyone inside crypto deeply understood this was a serious problem, to my mother knowing this is kind of, I heard this on Fox News, I heard this on these other news sources, that like this one group of people and firms was being unfairly targeted. Right before the election, I really wanted to inject data into the discussion. And before the Mark Andreessen, Joe Rogan thing, which I was thrilled that put it into the popular consciousness. Along with AIMA, did a study. And because I'm lucky enough to have this vantage point of hundreds and hundreds and thousands of touch points. And I just did a very, very simple study. I was able to get 250, actually close to 300 crypto hedge funds and portfolio companies to submit to the study. I also had about a 30 TradFi control group. And we published it. The Wall Street Journal wrote an article about it right when all of this was breaking. The timing was really perfect. And it was what we expected. So roughly 62% of crypto companies reported meaningful problems. And I want to be very clear about this, getting the most simple banking services. We're not talking about taking counterparty risk on Pepe. We're talking about checking accounts, right? Fiat in, fiat out, fully AML'd. All of these firms had an independent AML officer, independent audit, exactly the same as a early stage tech VC fund, which is just as volatile, if not more. 62% of the crypto companies reported either being debanked or serious problems. Less than 1% of traditional funds reported the same issues. So we were able to publish this right around the big firestorm. And I think I'm really happy we did, because, a lot of people get very emotional about these issues. And it got way up to Travis Hill. I went to Cynthia Lummis, and they were able to say, hey, this isn't just crypto people whining or tech people whining. This is real. It's backed by data. It's not anecdotal. I'll add to that. It's a piece we couldn't really publish because it's more anecdotal. But around a year ago, about a year and a half ago, when all this was occurring, I took it upon myself to with the contacts I have, and I was able to get about 20 state-level banks that were willing to. That we said, hey, look, all these firms being debanked, they're high-quality hedge funds. Do you want the business? Do you want the very basic checking account business? And about 20 state banks were like, yeah, we'd love it. This is perfectly legal. We want to grow our bank. And almost all of them said to me, because I set up a webinar where I would introduce the hedge funds to the banks as potential customers. And almost all of the banks said to me, John, thank you so much for doing this. We love this. Please don't make this list of banks public, because we have been warned by our counterparts in government, don't do crypto. And we were warned, if we see you doing crypto, it's not going to turn out well for you. And that was the key, Jonathan. This wasn't like a rule. This wasn't this wasn't public and transparent. Hey, we think banks should not do this legal thing because of XYZ. And by the way, they have a lot of purview. They have a lot of like gray area where they can say, look, we just think it's too risky, you know, but they're not allowed to kind of use mafia-like tactics of, hey, you know, you have a nice store here. You know, I'm Italian. I grew up in Brooklyn. I was lucky enough to get out and go to amazing schools because my parents worked hard. But I knew guys like that. I knew guys that would in Brooklyn that would say, "Hey, this is a really nice store. It'd be a shame if something bad happened." Right. And it sounds hyperbolic, but those literally were the phone calls. Not those exact words, but they were those types of phone calls. Which is, hey, we're not basing this on any law or any rule. It just if you do this, maybe you'll get more attention than you might like. That was happening. We know that was happening. I hope there's accountability, because even if you hate crypto, even if you think crypto is useless, you should be very scared that governments are able to issue shadow banning on things they don't like at any one point in time.
Good point. Well, now we know one of the main reasons why financial institutions are so hesitant to serve people in space. But how much do you think this held back the adoption of cryptocurrencies over the years?
So it's a great question. And when I was doing the interview with the Wall Street Journal, the journalist, who was a great journalist, by the way, who was professional. You know, she's not, she wasn't a huge fan of crypto or a skeptic. She was just a professional journalist. She asked a really good question. She said, in the middle, and no one ever asked me this before, but she said, well, John, she said, I'm paraphrasing her words, but she basically effectively said, well, John, but you have to admit, if these crypto hedge funds are answering the survey, if these crypto hedge funds are answering the survey, by definition, they were able to get banking. And it kind of stumped me for a second. I was like, yeah, that's a good point. But then I realized the clever and true sort of counterpoint, and I was lucky enough to think of it quickly, is, but there's a self-selection bias, there's a survivorship bias to the survey itself. I can't survey all the funds that were killed. I can't survey all the funds that were not able to get traction. Now, again, anecdotally, when I published the survey, I had dozens of people, some of whom were friends who I didn't know, reach out and say, this is why we died. Now, Jonathan, I don't like the speculative nature of these arguments. So I'm hesitant to say, oh, I can gather them all and say, oh, that would have been, theoretically billions of dollars. I don't know, because you never know if they're, maybe they died for other reasons. Maybe they were just bad hedge funds, I have no idea. But I think it's not unreasonable to say that when you have a 6x increase in core, I mean, this is the oxygen of a company. This isn't something on the fringes. This is the oxygen lifeblood of the company. When you have a 6x more likely occurrence of cutting off the oxygen of an organism, I don't think it's a stretch to say that it creates a material detrimental impact on the scale of that organism's ability to survive. So I don't know. I don't have numbers for you, but I do know that it has killed companies that I knew were doing well. It is. I know that for a fact, but I'm not going to speculate on numbers because I don't have the ability to discern that.
That makes sense. Well, let's look forward now. We obviously have a new administration that's really shaking things up with a presidential meme coin launch and even showcasing the Dogecoin logo on a federal government website. How do you see things changing in 2025 and beyond?
Well, I mean, look, it's kind of tone deaf to not acknowledge that the day that we're filming this, we're going through not just crypto Armageddon, we're going through an entire risk asset Armageddon, which it seems like we're going through far more frequently these days. And I kind of was kidding with you before we went live, and you were kind enough not to put me on the spot and ask me this question. I mean, I can give the standard reasons why everyone's talking about tariff policy and crypto. People are saying, oh, Trump's not moving fast enough. We're not saying all the things we want. I learned long ago not to pretend to be able to predict the cause or duration of short-term price movements. If I could do that, I'd be dialing in from my island somewhere. So I'll leave it to all the other talking heads to pretend that they know exactly what's going on. What I will say is, normally what I would say in these situations is, what's really changed in the last 24 hours that makes all of these assets that much less interesting to hold. I do think you have to consider the impact of things like DeepSeek for tech, and I think you have to consider the impact of the tariffs for risk assets. And we already have a lot of really interesting commentary. I think most people are leaning towards tariffs are generally bad for risk assets. We've had Jeff Park from Bitwise and a few others bravely try to point out why it's long-term good for risk assets. I don't know the answer to that. What I do know is the market is trying to price in this information. And the most important point I would say is we had a massive sell-off this morning in equity and debt markets. The volatility that I will make one prediction. I think that if you compare the volatility of, say, Bitcoin over the next 5 days, the volatility of those risk assets, particularly today, I think you'll see more muted Bitcoin volatility. The reason is we were able to sell off over the weekend. I've seen estimates from $6 to $10 billion liquidations in crypto markets over the weekend. The equity markets don't have that release valve because they don't have 24/365 trading. And so I'm hopeful that the inherent characteristic of crypto, which is immutability, fungibility, and participation, optional participation at any point in time, as long as you have a computer. I hope that those characteristics and the ability of those characteristics to have a release valve over the weekend will benefit, maybe not in price. I can't predict price direction. I know a lot of people wish that Bitcoin would go up in these sort of disaster-like scenarios, but I do think we should be thankful for the existence of that 24/7 release valve on both centralized and decentralized exchanges.
Yeah, that's an amazing point. And obviously anybody tuning into CNBC or other news networks, financial networks, Bitcoin is right there as a ticker alongside the big ones like the S&P. So obviously it definitely has a lot of influence throughout the traditional markets. And on that side, let's talk about DeFi just a little bit. Obviously, that allows things to work whether websites are working or not. There's different protocols, but without getting too much in the weeds, what could you say about the decentralized financial networks that would surprise even the most seasoned investors?
I don't think I can say anything that will surprise your listeners. So I won't try to do that. But what I will say is that, again, I come from TradFi, I come from commodities markets. I view a lot of crypto as a commodity just because that's the lens I was trained in. And commodity markets have their own DeFi, which was the OTC trading market. And it was kind of wonky and crazy, and it was a lot of guys screaming at each other on phone banks with 15 phones. But it worked really, really well. And so I see parallels to that. So a couple of things about it, which I think are going to be a true comparison, is that the OTC or DeFi markets tend to dwarf the spot or centralized markets in scale. And that both in terms of spot volumes and derivative volumes, particularly derivative volumes. So I think that's really healthy. I think having the centralized component is super healthy because spot markets tend to keep those OTC and derivative markets somewhat tethered to reality. We always used to joke at the NYMEX, if you're trading crude oil derivatives or natural gas derivatives, billions and trillions of dollars of notional value, and the price could sometimes get really, really wonky. There's a lovely element of physical deliverability, where we could always say, okay, you want to trade your crude oil at that price? Where should I deliver your crude oil to? Or, hey, when are you going to have my crude oil? And because at that point, the rubber meets the road, and you better have that physical deliverability. So I love DeFi. I love OTC. I think if crypto would ever lose the inherent characteristic of the ability to self custody and trade peer-to-peer without the use of a centralized exchange or government entity, it loses everything that makes it unique. And so I think that even though I work for a centralized exchange, obviously Brian Armstrong and Coinbase are big supporters, and we're big supporters of DeFi, and we have self-custody wallet options. Whenever I think about this, it's hard for me to think about it a bit old school in terms of how people will actually choose to vote with their value. I think about it this way, Jonathan. The average American, last time I checked, the average American's net worth, and that includes the value of their home, which let's pretend that that's liquid for now. Let's be very generous, was roughly $216,000. The average net worth, not income. If you physically take that amount of money out of the bank, if you go to the bank and say, give me $216,000 in $100 bills, it's a brick about 9 inches by 16 inches. That's it. Now, everybody, if they wanted to, could self-custody, and the real net worth is much lower than that in liquid value. Everyone could self-custody today, and they could have for the last 100 years. They can go to the bank and they could say, give me all my money in $100 bills, and they could dig a hole or put it under their mattress and do. But most people don't do that. So again, this is my personal opinion. I think having the option of self-custody is essential. It's absolutely essential. If you lose that, you lose what makes crypto revolutionary. I do think that centralized custodians and exchanges will serve a very, very important purpose for as you know, my lifetime at least, and maybe my kids' life, maybe society and the way we think about things like self-custody and the responsibility of ownership will change that dramatically in a few generations. I think that it is as important to have centralized options as it is to have decentralized options, but you can't have one or the other. Otherwise, I don't think this becomes what it has the possibility to be.
Wow, terrific insights. And it is interesting how things evolve over time, building on the past, such as the OTC markets. What do you envision as Coinbase's biggest opportunity or maybe challenge over the next 5 to 10 years?
So, I would say 6 months ago, I would have said the regulatory environment was our biggest challenge. I think a lot still remains to be seen in terms of what these rules will actually look like. But I think it's difficult to overstate what a relief, not just, by the way, for crypto, I think for artificial intelligence, for even centralized finance. I think it's hard to explain what a sea change in regulatory tone, in terms of tone from the top, in terms of real actions being taken, executive orders, rules, the individuals who are put into these positions. It's very, very difficult to overstate. I mean, so again, we go from about 2-3 months ago where there was an active debate in Washington about whether or not, and these are even people I spoke to who are, intelligent, smart people. Hey, I'm not so sure about this debanking thing. It sounds like much ado about nothing. You go from there to, in the last 10 days, I just want to make sure I get this right. You've got the new FDIC chair, Travis Hill, saying any effort to debank law-abiding customers is unacceptable in his opening statement, his opening post in that position. You've got Jerome Powell, the Fed chair, obliquely referring to this issue, saying bank regulation should not be causing law-abiding citizens and businesses to lose accounts. And then you have Cynthia Lummis, the Senator Cynthia Lummis, who's the chair of the new panel on digital assets, state anybody at the FDIC who gets rid of evidence about debanking will be prosecuted. So that I mean, again, to go from 2-3 months ago, where I was having conversations with potential chairs of again what we thought was a 50-50 shot of an incoming administration, saying, yeah, that's great, but I don't really think that that's true, and which is what inspired me to do the data analysis. To go from there to we know this happened, we just don't know how bad it is. That is, that puts regulatory, I think, at the lower end of that risk curve. I think, look, crypto has to still prove itself. We have to prove ourselves as an asset class. We prove that we're responsible, that we can be good stewards of capital. So, you got this idea of a strategic Bitcoin reserve. If that were to happen at the state or federal level, and then if other governments around the world were to, I think, probably they will, jump on board because they don't want to be front run by the U.S. acquiring Bitcoin, more likely than not. They're going to want to deal with human beings in centralized entities. Those entities have to be trustworthy. They have to be responsible. They have to be respectful. They've got to kind of really understand the onus, the burden, the responsibility of being stewards of public capital. So, I think we have those entities now. I don't think we had those many of them 5-7 years ago, but now we have them. I like to think Coinbase is one of them, an entity that can stand up to the scrutiny of transparency. Because if you work with a government, you are beholden to the citizens of that government. So I think having companies like Coinbase that are public, that have chosen to be fully open and transparent to retail investors, to stakeholders. I think now that those entities exist, it's much more likely these government entities will be comfortable transacting with them. Now, to give you an actual answer, because I did that thing where I evaded the answer, the biggest issue is going to be the integrity of the people and the companies within the asset class. Volatility is not the enemy. Crude oil traded negative. I want to be very clear about that. Remember, because people seem to have forgotten, crude oil, the world's most valuable commodity, the lifeblood of the global economy, for a brief period of time on a very credible, not saying they're not credible, a very credible Chicago Mercantile Exchange. Smart guys, they bought the exchange I was head of strategy for. You had to pay someone for a brief period of time to take the world's most valuable commodity and store it. That is insane. But we're not talking about shutting down the CME. We're not saying that market is entirely fake. We're not saying that everyone got rug pulled on crude oil during that period of time, because there's inherent trust in the infrastructure. So volatility is not the enemy. Volatility, unfortunately, is going to be a feature more than a bug for, I think, a while, to be honest. Although I will say, despite the last couple of days, we have seen decreasing overall Bitcoin volatility. People need to understand it. It is, as scary as it is less volatile than it was a year, 2 years, 5 years ago. But make no mistake, these are risk assets and will be for some time. And if crude oil can survive being insanely negative for a brief period of time, crypto can survive volatility. But it can only do it if you have trusted, mature players that are willing to subject themselves to transparency. There will be trade breaks. There will be disruptions. It's going to happen. But if they happen under the cleansing light of transparency, then we can survive as an asset class, just like crude oil survived being negative on the Chicago Mercantile Exchange for a brief period of time.
That makes sense. Yeah, obviously leadership is key, and there's a lot of trailblazing happening in this space. There's always something new coming out, and obviously mistakes do get made, but there are people out there that are intentionally trying to harm others to maximize their own profit. And we certainly covered a lot in this episode. Yep. Probably a good place to wrap it up. Everything from the challenges of debanking, to the ever-evolving regulatory landscape and what's important in the future. So I guess I just want to end by saying thanks again for coming on the show. It's a real pleasure.
Jonathan, thank you so much. Keep doing what you're doing. It's really, really important that kind of thoughtful sources get out. And I think you and your team are doing a great job. Thank you for having me.
Thanks, sir. Much appreciated.
Cheers.
This audio interview is an original broadcast provided by CryptoCurrencyWire. CryptoCurrencyWire, CCW, is a CryptoWire news and content distribution syndicate that provides access to a syndicate of wire services via InvestorWire to reach all target markets, industries, and demographics in the most effective manner possible. CryptoCurrencyWire is another brand under the Investor Brand Network. Investor Brand Network may receive payments for corporate communication relations, as well as various press releases and social media solutions provided to its clients. You should assume that officers and directors of Investor Brand Network or financial analysts mentioned hold a position in and may intend to trade the securities for their own accounts. This interview is not an offer or recommendation to buy or sell securities. Information in this broadcast is presented solely for informative purposes and is not intended to be, or should it be construed, as investment advice. As in all investments, investment in the featured company carries an investment risk. Listeners should review the company thoroughly with the registered investment advisor or registered stockbroker. This audio interview by Investor Brand Network is not purport to be a complete study of the featured company or other companies mentioned. Information used and statements of fact have been obtained from featured company and other sources, but not verified nor guaranteed by Investor Brand Network as to completeness and accuracy. Such information is subject to change without notice. Please see our full disclaimers and disclosures at investorbrandnetwork.com.